when the European Union announced the indefinite freeze of approximately $246 billion in Russian sovereign assets, it crossed a line that goes far beyond sanctions policy. This was not merely another punitive measure in response to the war in Ukraine. It was a moment that quietly redefined the rules governing property, sovereignty, and trust in the global financial system. For decades, the credibility of Europe's financial institutions rested on a simple assumption: state assets, once deposited within the EU's legal framework, were protected by law, not politics. Sanctions could restrict access, transactions could be blocked, but outright seizure remained taboo. What the EU has done now is suspend that assumption indefinitely. Legally, the distinction matters. These assets have not been confiscated, they are frozen. Ownership, in theory, still belongs to Russia. Yet in practice, an indefinite freeze blurs the line between temporary restraint and permanent appropriation. Time itself becomes a weapon, and in international finance, uncertainty is often more destabilizing than loss. Why does this matter? Because sovereign assets are not ordinary funds. They are the backbone of central bank reserves, the foundation of currency stability, and the ultimate symbol of a state's economic sovereignty. By immobilizing them without a clear legal endpoint, the EU has introduced a precedent that will echo far beyond Russia. Supporters of the decision argue that extraordinary crimes justify extraordinary measures. Ukraine's suffering, they say, demands accountability, and Russia must pay a price commensurate with the damage it has caused. Morally, this argument resonates. Politically, it is powerful. But geopolitics is not governed by morality alone, it is governed by precedent. Once a rule is broken for one adversary, others begin to ask, who might be next? If assets can be frozen indefinitely today, can they be seized tomorrow? And if law bends under geopolitical pressure, how permanent are legal protections in any Western financial center? This is the tension at the heart of Europe's decision. The EU seeks to uphold international norms while simultaneously redefining them. It wants to punish aggression without undermining the legal architecture that made Europe a trusted destination for global capital in the first place. In Jeffrey Sachs' words, sanctions are designed to change behavior, not to rewrite the foundations of the international system. Yet the freeze of €246 billion does exactly that. It signals that financial neutrality has limits and that access to Western institutions now carries geopolitical conditions that may not be reversible. This moment is therefore larger than Ukraine and larger than Russia. It marks a shift from a rules-based financial order toward a more conditional one where political alignment increasingly determines economic security. The world has noticed, and the consequences of that attention are only beginning to unfold. After the shock of the €246 billion aid freeze subsided, a new argument quickly spread across European capitals that frozen Russian assets could become Ukraine's financial lifeline and possibly even the deciding factor in the war. The idea was appealing because of its simplicity. War is expensive, Ukraine is exhausted, Russia has to pay. Yet history serves as a stark reminder. Money sustains wars more often than it ends them. At first glance, the numbers seem compelling. Hundreds of billions of dollars could be used to buy weapons, support budgets, and plan for reconstruction. Politically, the argument is appealing. Using Russian assets to support Ukraine would lessen the burden on European taxpayers and make the punishment fit for justice. But war doesn't follow accounting logic. The conflict in Ukraine is not a short-term campaign constrained by cash flow. It is a protracted war of attrition shaped by manpower, industrial capacity, logistics, and strategic depth. Financial resources are crucial, but they are not the sole determining factor. No amount of frozen money can replace the realities of the battlefield or alter the fundamental balance between a nuclear-armed state and one fighting for survival on its borders. Furthermore, the legal constraints surrounding frozen assets severely limit their usability. The principle remains locked. What is practically accessible is the interest generated, not the capital itself. Even the most optimistic estimates suggest this would only meet a fraction of Ukraine's annual wartime needs. Perhaps enough to prolong resistance, but not enough to secure victory. This distinction is crucial. Financial support for Ukraine could help it hold out. That doesn't guarantee that Russia will be defeated, deterred, or forced to negotiate on favorable terms. In fact, by protecting Ukraine from immediate financial collapse, Europe could inadvertently diminish the impetus for diplomacy, prolonging a war with ever-increasing human losses. There's also a strategic miscalculation underway. If Europe views frozen assets as a tool for winning the war, it risks turning a legal measure into a military promise it can't fulfill. When expectations rise faster than outcomes, disappointment follows, and disappointment can radicalize policy. From Moscow's perspective, this reinforces the argument that Europe is not a neutral legal entity, but a direct participant in the conflict. That realization is crucial. War escalates not only through actions, but also through interpretation. Financial measures become political weapons. Legal ambiguity becomes strategic hostility. Economic coercion is most dangerous when it is disguised as a substitute for strategy. The belief that financial pressure alone can force political outcomes often leads to protracted conflict instead of resolution. Sanctions harden positions. Asset freezes deepen mistrust. Neither guarantees compliance. Ultimately, billions of dollars frozen may help Ukraine survive longer, but survival is not victory. And survival bought at the cost of systemic instability could leave Europe facing a far more complex calculation, an unresolved war, weakened legal norms, and a global financial order quietly crumbling under the weight of politicized capital. The illusion, therefore, is not that money is important, but that money can decide what only politics and diplomacy can resolve. If Europe believes it can cripple Russian assets without consequence, it misunderstands both history and power. Moscow may be constrained within the Western financial system, but it is not powerless. Within Russia's borders lie over $1 trillion in assets, investments, factories, infrastructure, and intellectual property belonging to Western and European corporations. These assets are not abstract figures on a balance sheet. They are embedded in Russia's real economy, and they represent leverage. From the Kremlin's perspective, the EU's indefinite freeze signals a breach of trust that demands a response, not necessarily immediate, but calculated and strategic. Retaliation doesn't need symmetry to be effective. It needs credibility. Russia's options range from selective nationalization and forced asset transfers to tighter regulations, legal reclassification, and the insidious erosion of property rights for European companies operating in Russia. Even limited retaliation would have enormous repercussions. European companies that once viewed Russia as a long-term market would face sudden devaluation, legal uncertainty, and irrecoverable losses. Insurance mechanisms would be unable to compensate for political risk on this scale. Capital, once burned, rarely returns. Even more damaging is the signal such retaliation would send globally. If assets can be frozen in Europe and seized in Russia, the message to neutral countries is unmistakable. Geopolitics now overrides legal protections everywhere. The result is not the punishment of an adversary, but the rapid increase in economic fragmentation. Sanctions become counterproductive when they destroy trust faster than they change behavior. Retaliation turns a unilateral legal measure into a two-way collapse of trust. Europe may believe it is harming Russia, but Russia can also harm Europe, less overtly, but with more serious consequences. There is also strategic asymmetry. Russia, already sanctioned and partially isolated, has adjusted its expectations. Europe, in contrast, remains deeply tied to global capital flows and legal prestige. What Russia risks losing, Europe risks undermining its reputation as a safe, predictable destination for national and private assets. Once capital begins to question legal neutrality, it doesn't resist, it moves. Central banks are diversifying their reserves. Countries are mitigating risk. Investors are seeking jurisdictions perceived as politically separate. These changes are happening quietly, gradually, then abruptly. Therefore, retaliation is not simply Russia's reaction to Europe's decision. It is the mechanism by which the costs of politicized finance spread outward, affecting parties far removed from the Ukrainian battlefield. The irony is striking. A measure intended to punish aggression may in turn normalize a world where no asset is truly safe. In the power calculation, retaliation is rarely about revenge. It is about restoring the deterrent effect. Russia's counterattack, whether overt or subtle, will aim to demonstrate that financial warfare has no clear winners, only an ever-expanding circle of damage. And once that lesson is learned globally, it cannot be erased. Beyond Brussels and Moscow, the decision to freeze 246 billion euros of Russian assets is being studied quietly and meticulously around the world. In New York, at the United Nations, diplomats are choosing their words very carefully. Few are openly defending Russia's actions in Ukraine. However, many are deeply concerned about the precedent Europe is setting. The concern is not sympathy for Moscow, it is self-preservation. For most countries in the Southern Hemisphere, the international financial system has always been asymmetrical, shaped by Western institutions, Western currencies, and Western legal norms. What sustains participation is the belief that regardless of current politics, the rules will apply predictably. National assets, especially central bank reserves, are considered immune from geopolitical penalties unless there is war. The EU's actions have shaken that confidence. At the United Nations, the language used is cautious but revealing. Officials emphasize respect for international law, fair proceedings, and sovereign equality. These phrases are not empty rhetoric, they are signals. Many countries are questioning whether the financial power currently being exercised lacks sufficient legal binding force. If so, its implications will extend beyond the Ukraine conflict. In capitals from Brasilia to Riyadh, from Delhi to Jakarta, finance ministries are reassessing the level of risk. Diversification of reserves is being accelerated, not for ideological alignment with Russia, but for risk management. When assets can be frozen indefinitely for political reasons, neutrality loses its protective value. The logical response is to minimize vulnerability. This is the crucial point that exacerbates Europe's dilemma. The EU has long positioned itself as a defender of multilateralism and the rule of law. Its financial centers thrive on prestige, not coercion. By expanding legal boundaries in the pursuit of justice, Europe risks eroding the very trust that underpins its influence. Global leadership depends less on power and more on legitimacy. When legitimacy weakens, power must work harder to achieve the same results, and often fails. Freezing Russian assets may satisfy immediate political demands, but it complicates Europe's long-term position as a neutral arbiter in global finance. All of this does not diminish Russia's responsibility in the conflict, but international systems are judged not by how they treat their friends, but by how they treat their enemies. If rules are only flexible when convenient, they cease to be rules and become tools. Therefore, the ultimate question facing Europe is not whether Russia should be sanctioned, but how sanctions will reshape the system. Will the euro remain a reliable reserve currency? Will European courts be seen as detached from geopolitics? Will future conflicts lead to similar financial measures, further fragmenting the global economy? The world is watching closely, not with indignation, but with calculation. And calculation, once taken cautiously, rarely reverses quickly. Europe may believe it is defending the international order, but they also face the possibility that by freezing Russian assets indefinitely, they are teaching the world a lesson they did not intend, that in an era of geopolitical competition, financial security is no longer guaranteed by law alone. That lesson, once learned, will shape the global order for years to come.